Lesson 12. Getting under the hood of a strategy. If you've made it this far, you've already run a backtest or two, you've compared some strategies, and you've seen that different rule sets give you very different numbers. Two strategies can both be called profitable and still feel completely different to live with. One might trade 50 times a month with a high win rate and tiny profits per trade. Another might trade 5 times a month, lose more often than it wins, and still make more money overall because the winners are huge. This lesson is about understanding why. Why does a strategy behave the way it does? What kind of market is it actually built for? And when the numbers disappoint you, where do you start tuning? Because here is the truth I want you to hold on to. Most strategies don't fail because the idea was bad. They fail because the idea was applied to the wrong market, or the entries were too loose, or nobody bothered to write a real exit. So let's walk through what is really going on inside these things. The 4 strategy families. Almost every strategy you'll ever write or borrow falls into one of 4 buckets: trend following, mean reversion, momentum, and breakout. There are blends and hybrids, sure, but if you understand these 4, you understand most of what is out there. Let me go through each one honestly, because the marketing makes them all sound amazing. And the reality is that each one shines in a specific market and bleeds in another. Trend following is the one most beginners end up with, and there is a reason for that. The core idea is simple. Once a trend has clearly formed, climb on board and ride it. The classic signal is a moving average crossover, where a short-term average crosses above a longer-term one. Sometimes confirmed by an indicator like ADX that measures how strong the trend actually is. The logic is intuitive. If Bitcoin has been climbing for 2 weeks and the trend is strong, you buy and hold until the trend breaks. The honest part about trend following is that the win rate is usually low, somewhere around 40 to 60%. You'll lose a lot of individual trades because most trends are false starts that fizzle out. But the trades that do work tend to be big. Your average winner is meaningfully larger than your average loser, and that is what pays the bills. Trend following shines in bull markets and in clean directional bears, and it punishes you in sideways choppy markets, where moving averages whipsaw back and forth, buying the top and selling the bottom of every tiny swing. Mean reversion is the opposite philosophy. The idea here is that price tends to snap back to its average. So when something stretches too far from the mean, you bet it'll come back. The classic signals are RI dropping below 30, or price piercing the lower Bollinger Band. You buy the dip, wait for price to drift back to the middle, and exit. Mean reversion has a high win rate, often 70 to 85%, and that makes it psychologically soothing. You win most of the time. But the profits per trade are small, and when price doesn't revert and just keeps trending against you, the losses can stack fast. Mean reversion is amazing in ranging markets and miserable in strong trends, where the dip you bought turns out to be the start of a much larger move down. A lot of people lose serious money trying to catch falling knives with a mean reversion strategy in a bear market. Momentum strategies are basically, the strong get stronger. Instead of waiting for a pullback, you buy strength. RENC in the bullish zone, a massive crossover, price printing new highs, volume exploding. You are chasing the move, betting it has further to run. These strategies can produce spectacular single trade returns in a bull market. The downside is they're easy to fool. False breakouts and bull traps are everywhere. The win rate sits around 50 to 70%, and drawdowns can be ugly when momentum suddenly dies. Momentum in a bear market is brutal, probably the worst of the 4 in that regime. Breakout strategies are a cousin of momentum. The idea is to identify a key level, a recent high, a resistance line, a Donchian channel, and buy when price breaks through it. Volume confirms. Volatility expands. You are catching the start of a move rather than chasing the middle of one. Breakouts work well when markets trend, but the signature problem is false breakouts. Price pokes through the level, sucks in buyers, then collapses back. Even solid breakout strategies end up with win rates around 50 to 65% for exactly this reason. Here is the through line, and I want you to internalize it. None of these is the best strategy. Each is a tool for a specific market regime. Trend and momentum love clear bull runs. Mean reversion loves sideways chop. Breakouts need volatility to feed on. If you take a momentum strategy into a ranging market, you will lose money. It is not because the strategy is broken, it is because the strategy is in the wrong market. A huge chunk of strategy analysis is just asking, what kind of market is this, and which of my tools actually fits it? How to combine indicators without fooling yourself once you understand the strategy families. The next question is how to actually build the signal. Most strategies use more than one indicator, and the way you combine them matters more than which specific indicators you pick. The principle I'd recommend is what I think of as the golden triangle. Trend, plus momentum, plus confirmation. Pick one indicator that answers, what is the overall direction? That might be an EMA stack, where a short-term average sits above a longer-term one. Pick another that answers, how strong is this move? Massachusetts CD or ADX all work. And pick a third that answers, is this real? Usually that is volume. If price breaks out on no volume, the breakout is suspect. If price breaks out with volume 50% above average, something is actually happening. The point is that each indicator should answer a different question. That is what makes a combination effective. Where people go wrong is stacking indicators that all measure the same thing. 4 moving averages piled on top of each other, all telling you that price has been going up. That feels like thorough analysis, but it is the same signal counted 4 times. It doesn't make your entry more reliable. It just makes you feel more confident, and confidence without new information is dangerous. Another principle worth holding onto is to mix fast and slow indicators. Fast indicators like RSI or a short MACD react quickly. They help you time entries. Slow indicators like a 200-period moving average or ADX move glacially. They help you confirm the bigger direction. Pairing them gives you both. A common pattern is to only take longs when the slow indicator confirms an uptrend. Then use the fast indicator to find the actual entry moment. You don't enter on the slow indicator alone because you'll always be late. You don't enter on the fast indicator alone because you'll get whipped around by noise. When you are testing combinations, the right approach is the same as testing strategies. Run them as a tests over the same historical period. A strategy with just an EMA, then the same strategy with RSI added, then the same again with volume added. Look at the numbers honestly. If adding RSI bumps your return from 12 to 15% and lifts the win rate, that is a real signal the indicator is pulling weight. If adding volume doesn't move the needle, the volume filter wasn't helping in this market, and you should drop it. Simpler is better, both because simpler strategies overfit less, and because they're easier to debug when something eventually breaks. Diagnosing entry problems. Most strategy problems show up first in the entries. Either you are trading way too much, hardly at all, or you are always late to the party. 2 frequent entries are the most common. You look at your backtest, and you see 120 trades in a month. Mostly tiny wins and tiny losses, and a huge chunk of your gross returns eaten by fees. The fix is to tighten your conditions. If you are buying every time RC dips below 40, narrow that to 30, and require that RSI was already below 30 on the previous candle, so you know the oversold is sustained rather than a one-candle spike. Add a trend filter so you only buy in the direction of the bigger move. Add a volume floor so you don't trade in dead hours. You'll typically trade half as often and win more often. That is almost always a good trade. 2 conservative entries are the opposite problem. Your strategy takes 5 trades a month and misses everything you wanted to catch. The usual cause is stacking too many filters. Every filter you add is another reason to skip a trade, and at some point you've filtered out the good setups right alongside the bad ones. Loosen the thresholds. Drop a redundant filter. Or if the strategy is genuinely good but selective, just run it on more trading pairs. 2 trades per Pascal year across 10 pairs is 20 trades a month, which might be plenty. Lagging entries are sneakier. You look at your trades and notice you keep buying near the top of the move. Then price immediately pulls back and you are underwater for ages before either scraping a tiny profit or stopping out. The cause is usually that you are entering on a slow indicator. A 50 over -200 moving average crossover is a famous signal, but it is badly lagged. By the time it crosses, half the move is already over. Switch to a faster trigger. Keep the slow indicator as a directional filter, but use something quicker, like an RSI crossing 50, or a short MACD flipping positive, to actually time the entry. Diagnosing exit problems. Beginners obsess over entries. Experienced traders know the exit is where the money is actually made or lost. The first classic exit problem is taking profit too early. You've set a take profit target of 3%, and most of your trades exit the moment they hit it. Your average profit per trade is tiny, and you watch wistfully as price keeps climbing for hours after you are out. The fix is usually to widen those ROI targets. Or better, switch to a trailing stop once you are in profit. A trailing stop lets the trade run as long as price keeps moving your way, and only exits when price pulls back by some set amount from the high. You give up a little at the top of every move, but you capture the big moves that a tight fixed target would have killed. The second problem is a stop loss so tight it gets hit by ordinary noise. Crypto is volatile. A normal pullback inside a healthy uptrend can be 5 or 6% on a boring Tuesday. If your stop is at 3%, you'll get stopped out on almost every winning trade before it has a chance to develop. Look at your backtest. If the percentage of trades exiting at the stop is above 30, your stop is probably too tight. Widen it. For low volatility coins, maybe 7%. For Bitcoin itself or a small cap alt, 10 or 12% isn't unreasonable. Or use an ATR-based stop that scales with each coin's actual volatility, so you are not fighting the nature of the asset. The third exit problem is having no exit logic at all. A surprising number of beginner strategies just set a ROI and a stop loss, and never write an active exit signal. That means if price wanders sideways for days, you are stuck in the trade, your capital locked up, waiting for one of the thresholds to hit. The fix is to write actual exit rules. A moving average death cross, RIC flipping overbought, Massachusetts CD rolling over. Any of these can be a signal that the move you are riding is done. Get out, free up the capital, look for the next opportunity. Risk management, the unsexy part that saves you. I want to finish on risk management, because it is the part people skip past, and it is the part that decides whether you survive long enough for your edge to play out. Position sizing is the foundation. The simplest version is a fixed stake. Every trade uses the same amount, say $100, and you cap the number of simultaneous trades at something modest like 3. This is what I'd recommend starting with. It is boring. It is predictable. You always know your maximum exposure at any moment. A more flexible version is percentage-based, where each trade uses a fraction of your available capital. This compounds naturally as your account grows and shrinks gracefully when you take losses. It takes a little more attention to the math, but it is how most professionals size positions. There is also the Kelly formula, which uses your win rate and your risk-reward ratio to compute the theoretically optimal fraction of your bankroll to bet on each trade. The math is elegant and the idea is appealing. In practice, almost nobody uses full Kelly, because it is violently volatile, and because the inputs, your win rate, your edge, are estimates, rather than facts. A common compromise is half Kelly, which gives up some growth for a lot less variance. The Kelly formula assumes you actually know your edge, and in trading that is almost never exactly true. Beyond position sizing, Freqtrade gives you protection mechanisms you should seriously consider turning on. A cool-down period that forces the bot to sit out for a few candles after a loss, so it can't immediately revenge, trade the same pair. A max drawdown circuit breaker that pauses trading if you've lost more than some threshold within a given window. A cap on how many positions you'll stack into a single pair. None of these make your strategy more profitable in a backtest. What they do is keep a bad stretch from becoming a catastrophic one. A strategy that loses 5% in a day happens to everyone eventually. A strategy that loses 50% in a week because the bot kept doubling down on a losing position, that only happens to people who didn't bother setting protections. The bigger picture here is what I want you to take from this lesson. A strategy isn't just a set of entry rules. It is a hypothesis about how a particular kind of market behaves. Trend strategies assume markets trend. Mean reversion assumes they oscillate. Breakouts assume volatility expands. When the market matches the hypothesis, the strategy makes money. When it doesn't, the strategy bleeds, and no amount of parameter tuning will fix that. The fix is either to wait for the right market, or to run multiple strategies that cover different regimes, and accept that some of them will always be underwater at any given moment. When you are improving a strategy, change one thing at a time and test. Tighten entries, test, add a trailing stop. Test, widen the stop loss. Test, if you change 5 things at once and the backtest improves. You have no idea which of those 5 actually helped, and you've probably overfit to noise. Patience here pays off in real money later. And always remember that great backtest numbers are the starting point of analysis. not the end of it. They tell you the strategy worked in the past under specific conditions. Your job, before you trust it with real money, is to understand why it worked, what conditions it actually needs, and what happens to it when those conditions go away. That is what we'll keep building on for the rest of the course.